Hello, Marc from ADM Investor Services International, with some thoughts on all the issuance that we're getting in terms of both government bonds and indeed corporate bonds, and on the other hand, the gradual easing back by some of the central banks, specifically in this case, the US Fed. In terms of their activities in government bond markets and what sort of impact that might have on financial markets as we go forward. So my first chart today is a very simple chart. It's a chart of the G4 central banks, the Fed, the ECB, the Bank of Japan, and the Bank of England's balance sheets as a percentage of GDP. As one can see, it has skyrocketed over the last couple of months, particularly. We now stand at a whopping 44.3% of the GDP of those countries. That is up from just 35% just a couple of months ago. That is a very significant move, and given that you can see that how long it took for the previous increase over the prior 5 years, it does put things in perspective. So they have been injecting massive amounts of liquidity, and actually their percentages, their holdings as a percentage of GDP obviously will rise as economies contract even more, not just as a function of their purchases, just to say. Nevertheless, I think one needs to look at it in terms of what happens next. So what we can see in the second chart is the Fed's purchases of US Treasuries over recent months. As one can see, they have risen very, very sharply. April was a record, roughly 980 billion of purchases by the US Fed. And one can see how that has basically backstopped all the increases in issuance. However, things are about to change. This week, the US Treasury announced that it will be issuing a record $3 trillion of US Treasury securities in the May through July quarter. That's not for the whole of the financial year, just for that quarter. That happens at the same time, and this is where the prior chart comes into play, as the Fed is starting to wind back. So we come to my third chart, which basically highlights that in the January through April period, the US Treasury issued 1.85 trillion. So we're going now to 3 trillion, and the Fed purchased 1.6 trillion. The Treasury is now going to issue 3 trillion for the current quarter, May through July, while the Fed has already announced that it's only going to be buying some 200 billion of US Treasury securities in May, and probably, depending on market behavior, in June and July, perhaps even winding it back further. Therefore, financial markets will have a lot more in the way of issuance to actually take down. Now, a further point here, and this comes, well, first of all, perhaps we should see how this increased issuance of US Treasuries is impacting the US yield curve. As we can see in my fourth chart, which is the US 2 versus 30-year spread, with a spread at the bottom of the chart, which has widened out to 122.4, but remains within its broad range of recent months. And on the other hand, that one can see where that's happening. It's both an increase in 30-year yields and a very marginal decrease in US 2-year yields. So it is having an impact on there. Is it actually having any impact on corporate issuance? Because this is where my area of concern is. As we can see from my fifth chart, we've got the US investment grade average spread versus US Treasuries. That has basically been going sideways for a couple of months. My concern is that we had a record 289 billion of US dollar denominated corporate issuance in April, and we've already got 61 billion month to date, and that this is going to start see some pressure as the Treasury effectively starts to crowd out some of these purchases. So it's something to think about as we go forward. That's the thoughts for this week.